This helps her be a stay-at-home mom for their daughter, which is what they were looking for.
That's amazing.
Like the outcome of this stuff, they're living and building the life that they want, how they want on their terms. That is freedom, right? That is control. A lot of people, I think, they think financial freedom and they think retirement. They're designing it around their life. That is financial freedom.
When you guys are looking at property management software for your storage facilities, there's a ton of options out there, but no other option compares to Tenant Inc. Tenant Inc. is going to be your one-stop shop solution that has an amazing amount of tools that you can deploy at your fingertips to maximize the value of your facility, to operate it more efficiently, more effectively. They have an open API where you can back in almost anything you want. You own your data, and it's just an incredible solution. I can't say enough good things about these guys. Link is in the show notes. Be sure to check out Tenant Inc.
What's up, everybody, and welcome to Self-Storage Income. Today, we are kicking off 2025 right. I mean, I guess we're not kicking it off. It's been a few episodes, everything, but we're showing you guys all of these people. We're giving case studies and walking through people that had gotten started. They'd either started with little or nothing, and they got into this amazing business. And this is not like in the past. This is recent. These are people that are recently doing. And we're going to talk about getting capital, how that works, because that's a big part of it. Obviously, this is real estate. Where do I get the money to do this? And how do I go about even thinking about getting money, if that's investors or a bank? I want to do this, but where does that come from? And I think there's a lot of misnomers with that. Like, if you're in it, it's because you have money, where that's not true. Part of real estate is the ability to get money. That's what we do. That's what everybody does. You have to go find money to invest in real estate. So don't think that it's like, I have to do this, but others don't.
Yeah, no,
right?
You're exactly right. Well, and again, like we've talked about, there's a couple things. We've talked a lot about, at the beginning of this year where 2025 is going to go and all the opportunities coming up. So this is a perfect time to kick off and say, hey, these are the resources you're going to need and how to get them. And here are the people that are doing it right now today. And again, no matter what stage of the game you're in business acquisition and real estate, you're going to need capital, and you're most of the times not just going to have your own. You are going to be utilizing a bank or investors or a partner, whatever that is. So I'm excited to dive into this today, man, and share some real life stories of amazing people in our group who have come in, done it. They're out there doing it today, executing. It's freaking amazing.
Some of the stories too are so inspirational, and we've had we've had someone on the podcast about people that lost everything, like literally everything. Their house belongings, everything burned to the ground. They had to move to somewhere where they didn't even know, and from there they're like, I got to change something, and they went and figured out how to get into self-storage from nothing, literally ashes. And it's like, that is so, and too, it's interesting also to hear those stories because there's something holding them back before. It's almost like that comfort or whatnot. And it took them to lose everything to actually go into it, which is so counterintuitive. Normally you think, no, I need to get, or I need to have something to do something, where these people, not most of the time, lots of the time, it's the opposite. I mean, we have stay-at-home moms, new child, that go out and they do this to try to change their life. It's not how I think a lot of people think, and I love it. It just makes me so excited. That is what the podcast is all about. And so we're really excited to go through this and to explain some things about raising capital and what it means. So what we'll do is I'm going to talk a little bit about capital sources, and then we'll start out and we'll do some of these case studies. Basically, you have two sides, everybody. So you have equity and then you have debt, which that's how 99% of all deals are structured. And what that means is, just like if you bought a house, you're putting money down and then you have debt on that asset. So that money down is called equity. The two sources we get that from is we call OPM, meaning that the money that you put down, lots of people, most 95% of everybody, you go get investors and other people to help you put the money down. Then you get a bank or a financial institution to give you debt. A lot of people don't understand that. They think, oh, investors means you buy the whole thing. So if I'm buying a $1 million asset, I need investors to pay for the $1 million. And or that I have to come up with something down and then investors go into that. No, that's not how it works. Like you're putting 20 or not 20% down, 30, 35% down on that $1 million. So you're getting $350,000 from investors. And then you're buying that $1 million asset because you're getting a loan from a bank on the rest. The ownership of that asset then is divided up amongst the equity. And there's many ways you can kind of do that. And we're going to talk a little more about raising capital and things in 2025 as we go through. We will follow this episode up with one that involves a securities attorney. Then that will get into the legality of selling securities. I am not going to dive into that for a bunch of reasons. I'm not an attorney, and we use a securities attorney to do this. That's not what I do. But we will talk about what it means and some basics, right, going into it. And knowing that if you do want to go raise capital and bring money, you just get an attorney. So, and that's actually the best thing ever. People are like, oh, that scares me. I'm like, it actually scared me the other way around, meaning I don't need to know. I just ask somebody else and he just tells me, do this and this and this. We say, okay, and we do it and we're fine. So you don't actually have to know all of that, but you do need to understand the frameworks, which will go into it. Everything else, you just give to an attorney and they take care of it. We'll talk about all of that. And I don't want to make it also, though, sound more intimidating than it should be. And I know this because I didn't raise capital for a long time. And that was really actually hard because that meant me and my partners, we worked 2 jobs for years as we tried to do this because we didn't know how, we didn't want to. And it was just so much easier when I realized what it was and we got an attorney to help us. And then I'm like, oh, I don't know why I was intimidated about this.
Well, you don't know what you don't know, man.
You don't know what you
don't.
At
the end of the day, and that's why it's so important to listen to the podcast, to go to the groups, to connect with people that are out there doing the same thing or have done more than you have. It's really, really important to get that insight because, you just don't know what you don't know. But, man, we got our first case study here, first individual, Charles. I love this one to kick it off because we're talking about raising money, where it's coming from, how it's going to work, how we're structuring deals. This is a seller finance deal. So he joined our group back in 2023, closed a deal at $350K, 4% interest. So this is just in April here, so not quite a year. So $350K with 4% interest.
Which interest rates in the market were not 4%, as we know.
Unbelievable. Yeah. so, and 2, I mean, you compare this to any other asset class, right? You're going to go out and buy something that's really going to cash flow for $350K. There's not a whole lot of opportunity out there for that, especially in real estate. So that's amazing. You compare that to duplexes, any of that. I mean, storage is just incredible in that aspect. Immediately implemented 100% rate increases. Love it. That's amazing. Found a deal. This is the on-deal market, just using
Crexy.
That's wild.
Yeah. He used Crexy
there, man.
Seller finance took care of the deal. So what that means, everybody, is the seller acted as the bank. The asset was so under market, he was able to buy that, then bring rates to market rates, which was so far under that average to be 100%, and didn't even have to have a bank.
Yeah.
And then the seller gave an interest rate on that of 4%. So it was also non-recourse. 4% when in the market, that would have been 8%, at the time. Mm-hmm. So the value creation in that is stunning.
Yeah.
I mean, he bought it for $350,000. You literally double rates, and you have a non-recourse seller finance loan at 4%, which, once again, like you mentioned, try to go find duplex in most markets that are $350,000 or under. Right?
And raise the rates 100%. Yeah. No,
not possible.
It's not happening.
The other thing, amazing.
Man, I love about this is it's clear that this facility was underperforming, huge value add. If you can go in, increase rates 100%, bring them to market, that's amazing. But the idea that you're seller financing something where the previous owner is literally probably getting paid the same or more than what they were previously with this individual in it, but he's able to buy an asset at a certain value and immediately increase the value of that asset on the back end, where he's not only paying off the debt, but he's actually increased the value to a point where he's still getting just amazing cash flow, I'm sure, from the deal.
Yeah.
It's
the seller doesn't have to pay taxes. It actually works out really good. They get that income.
Those great points too.
It's a win-win for everybody and a huge win for him.
Love seller finance.
Love to see that.
For sure. All right, man. Next up, we've got Elizabeth and Caleb. They joined in 2024, our self-storage income group. No storage deals then. Been cold calling without a ton of luck. Been trying. Found a deal on Facebook, nonetheless.
Yep.
It's amazing. 7,200 square feet, 56% occupied. That's promising. Severely mismanaged. Value add. Rates in some units hadn't been raised for 20 years.
Yeah, you think about how much rates have gone up in the last 6 years. Over 20 years?
20 years.
Holy cow.
Financed at 25% down and closed in November 2024. That's freaking awesome. Good work, guys. That's so cool to see.
New child, like I love seeing this. This is a family that they had no experience. They have a new family. They want to change their life. They're thinking about their daughter in the future. This stuff's inspirational to me, right?
Yeah, that really is.
They went out 72,000 square feet, and it was being mismanaged by basic stuff. So this isn't crazy. Once again, we show them how to do all this stuff, how to manage everything else. They were able to buy something that they're going to increase the value, not only the value, but they're going to cash flow. And this helps her be a stay-at-home mom for their daughter, which is what they were looking for.
That's amazing.
Like the outcome of this stuff, they're living and building the life that they want, how they want on their terms. That is freedom, right? That is control. And I tell a lot of people this when I look at even like financial freedom, everything else. I did work a job for a decade when I was doing it, and I was fine with that. In fact, that meant financial freedom to me. Why? Because I was doing what I wanted to do. Now, I didn't have to have it, and when I got paralyzed, right, I lost my job, and that's why I had it. All of a sudden, so I could do what I want to do. But I was choosing to work it. I was getting paid good money, and that helped me build my storage business on the side. And I really valued that job. And the people that I worked for, this big company, and it was the benefit of that to me was astronomical, right? And that allowed us to plan for our future, save in case something happened to me, and my wife to be able to stay home with our 4 children. And to me, that's what we wanted. That was like what we were trying to design. And we had a backup plan, and it ended up saving me. And so a lot of people, I think, they think financial freedom and they think retirement. But this, however they want to do it, whatever, that they're designing it around their life. That is financial freedom. You have choices.
Mm-hmm. No, exactly. And again, you just have the freedom. You have the freedom to do what you want, how you want to do it, subject to none. I'm big on the whole being self-reliant concept.
Yes.
It's such a big, important thing, especially in the world today. It looks like they had done conventional financing. They wouldn't put the 25% down. Conventional financing. AJ, if you were going out and doing that today, what are some things that you would want to consider if going conventional financing, working with banks? Where would you find that 25% down if you didn't have it on your own?
Yeah, so a lot of times we're looking at assets that are sub $1 million, especially for starters. This is a great way to create value and income because those are the assets that big firms and people with lots of money, they're not generally buying because they can't allocate small amounts of capital in the form of $150,000, $200,000. We have to deploy millions for it to even make sense. And so that means there's this huge gap in the market with these assets where they don't have sellers that are going to pay premiums, but that also means the type of buyers that are buying them are not sophisticated operators. So they're normally the side thing and being ignored. We see that all the time where you can turn that asset around easily. What that means, though, if I need to get financing, I usually need to be with a financial partner that understands what it takes. So if I'm working with a bank, they need to understand my business plan. This is 50% occupied. This is why it's being ignored. So we can change this around. So the LTV, right, that debt to equity, all those things moving in, they may not be very good right now, but that's actually why we're buying it. And you need to be able to show them. So for that reason, that will put you in a spot where you need to go to lenders that understand those things. That generally leads to things like understanding that market. That's why community banks, as well as, any local bank that works good. Credit unions, those are great. The national bank that we see that works great for this is Live Oak Bank. And I went there. That's why they're actually a sponsor of this podcast, which they're the only outside sponsor that we even have. Every other one is one of our companies we know because we send people to them. They work with us. We've been out to their campus, and they do these kind of loans for storage facilities because they know that business, and they do small business loans, which works out great because then you don't have to put as much down, right? But more importantly, they get it. Like if you present a business plan, they can see it. So if you went to a bank that doesn't know storage, doesn't know that market, the only thing they're going to look at is how much money does this thing make today? What is that risk? And what happens if we have a default? They are not going to look at the plan. They don't understand how you execute it. They don't know what the outcomes are of that. So they're going to be way more hesitant. And the more hesitant the bank is, the worse the deal is that you will get because they're going to offset risk. So you need to go with individuals. The reason why credit unions lots of times work well too, though, is because they know that market. So like credit unions are like, oh, I get it. This is a great spot, things like that, right? But there's another reason for small business loans a lot of people are going into to get those. They work great for storage. But the reason we use Live Oak Bank is because they actually have the underwriting capabilities. Normal banks with small business loans, you need to be aware of this because it can get you into trouble. They go through, but they need to get approval from the government. So they go through, they underwrite your asset, everything else. 2 months later, the government comes back and says, we don't accept it. All of a sudden, you're 2 months down, and now you're starting back over. Whereas a bank that has the underwriting or the pin setting ability, they actually do that for the government. They're the ones that do the approval. So if they tell you you're going to be approved, you're going to be approved because they're the ones that set it. Mm-hmm. So you're not worried about this mismatch and going back and forth. So what that means, everybody, if you're going out and doing that and financing it today, you need to understand the big problems you're going to have is loan to value, right? You may say, okay, we think it's worth this, but it is the payment ability, right? So that debt load to how much it can pay off it because interest rates went high. So that means they're looking at how much cash flow does this say? What is the burden of the debt? And what is the ratio there? Mm-hmm. So if interest rates go from 3 to 6, you increased that burden of payment, even though the cash flow and everything's the same. It worked at 3, now it's 6. It doesn't work. That's why we're getting obviously better deals, but still that's going to be the problem. So that means you need to have a business plan that will show how we get there. So you need to work with people that understand that. There are people though. That's the great news. And there's experts that do it.
Mm-hmm. Well, and sometimes too, what I've seen is if the bank is having an issue with, you're describing that debt service coverage ratio, right?
Yep.
Like when those banks have an issue with that.
The DCR.
Yep, exactly. Yep. So if there's an issue, you can potentially bring in more capital to offset that a little bit if there is some kind of problem. So don't just take that as like, oh, it's a hard no, like deal's done, can't do it. Say, okay, well, if I didn't put just 25% down, what if we came in with 40% down? How does that look?
And guys, a bank saying no is part of it. Like I would never, ever assume that a bank was going to say yes. What I mean by that is when we go out to look for people to find, we look at lots of different organizations because I realize that all the banks, a credit union, a local bank, Live Oak Bank, or whatever it may be, they all have different appetites and they have different interests. Saying no to you doesn't mean universally that financial lenders are going to say no. That's not what it means at all. They're saying, no, we can't. We had financial partners that they were perfect for a region, but then the upper, C-suite at the company said, hey, because of conditions in the market and where our assets are, we're risk off. That means we won't underwrite at all debt. Like we're not going to do it. Or excuse me, we're not going to underwrite developments because we view that that's risky. It has nothing to do with your project, anything else. That comes from the bank. So don't go to a bank and they say no and say, oh, I can't get financing.
Yeah.
Expect them to.
Right.
And expect that if you went out to 10 people, some of them are going to say no. You need to figure out why. So why doesn't this work for you? And then go to another one and put down, change what you need to, get better. But that's just part of the process, everyone.
It truly is. Next case study, man. We've got Peter coming in hot, joined early 2024, bought his first deal within 6 months of joining the group. That's awesome, man. Now has got a second offer on another project, another deal. It's amazing. His first facility was purchased for 10% down, which is awesome.
10% down.
On a $509,000 property. Again, cheaper than a lot of other assets in similar real estate, acquisitions and such. So
especially when you're looking at and we use this a lot, duplex. And the reason why we compare it is a duplex, you have 2 doors. That means you lose one, you're completely negative. If you lose one tenant, you are negative in cash flow.
Yep.
Right? You had little cash flow to begin with. Most duplexes don't cash flow. Whereas then you look at the same price for a storage facility and you have 100 doors. I mean, you can lose 20% of your tenants and still meet your obligations.
Mm-hmm. Yeah.
That's wild.
It's amazing.
As far as investment goes.
No, you don't have that kind of buffer when you just got a couple people. So that's awesome, man. 10% down. It sounds like maybe it was a seller finance deal. Maybe it was an SBA deal. 10% down.
Usually 10% is SBA loans.
SBA.
So that's normally an indicator of an SBA loan because they will go down to that amount.
Yeah.
Next awesome. One, we got AC. My man. So AC, he joined with us in November 23, closed his first facility by May 24. It was $1.25 million, 20,000 square feet, and the seller financed this with 4% interest only. Now, right now today, interest rates are north of 7%. Remember when we're talking about DCR, cash flow, right? That change, if you're talking about $1 million, the difference between 3% and 7 or 8% interest, not only on the DCR, but going into your pocket, the difference is massive. That is a huge difference on those payments. Once again, this was a mom and pop value add facility. This is what, we preach a lot here. This is how I started out. And this is a perfect example of a nice mid-sized facility and seller financed, mom and pop value, low interest rate, and the seller is taking that risk and the assets backing it. This is also what we tell people when it comes down to, well, a bank won't give me money. Okay, we've been there. I bought so many deals and banks wouldn't give me money, and it wasn't even because of us. No banks would give money because it was a great recession.
Yeah.
Banks were all going bankrupt. At that time, you had 300 banks in this nation went out of business. Done. Over. And we're out trying to get loans. Mm-hmm. Right? Like in an asset too, by the way,
like you crazy?
That nobody liked.
Yeah.
This was an asset that they didn't want to lend to before. So a lot of people say, well, I can't get loans, right? Well, yeah, okay. So we went and got seller finance. Out of our case studies that we've even gone over right now, you noticed a trend here? Mm-hmm. Most of them are seller finance deals. And 2, you say, well, I don't have an in. These are people that just literally went online, Facebook, Crexy. I mean, this is not like they had an in. They didn't have anything with brokers. Mm-hmm. So I love this story because it shows, and it reminds me a lot of how we started out, right? I was talking to a guy and he's like, oh, well, I might sell. And I said, well, hey, I might buy, but obviously I can't get bank financing. Would you be willing? And we just made a deal.
Just figured it out.
A mom and pop facility, and we just made a deal. And we're doing those. We're getting seller finance deals on $8 million deals in cities that have over 2 million people.
Think of the benefits for a seller on seller finance. Like, I've always wondered this when anybody approaches a seller on seller finance. I'm like, why would you not want to do this?
Yeah.
I mean, it makes all the sense in the world.
And especially in today's market. Right now, financing for real estate is really hard, even for self-storage. The markets are very challenging. Live Oak Bank is a specialist in financing for self-storage, including SBA loans. They are one of the leaders in financing all sorts of deals and deal size. We trust Live Oak Bank for their specialty in self-storage, their unique approach, and how they help their customers go through the process so there's no surprises. That in itself is a testament to their exceptional service and support. So whether you're looking to acquire, build, or expand a storage facility, Live Oak Bank has to be number 1 on your list to call. Click the link below right now so you can experience the difference that a dedicated self-storage partner can really make. And I'm going to give this to you here before we move on and talk about investors and getting the capital down. So we do what I call my 3-offer strategy. That's in the book. You guys can go pull it up. We actually give examples, everything else. The new one, we give lots of examples that are true in today's market. The 3-offer strategy basically comes like this. If I have to pay 8% interest, that debt coverage ratio and just what it's worth, falls dramatically. Because value, especially when we look at cap rates, things like that, doesn't include debt. So when you say this is worth $1 million and that equals a 7 cap or a 6 cap, that doesn't include debt. But buyers don't get to do that. Debt's a real thing and it creates a reaction. Either we can buy or we can't. So we look at it and say, that's great. It may be worth to you a 7 cap, but once I include debt, I literally can't pay. That's negative for me with these interest rates. So I can't pay a 7 cap. That means I got to pay a 9 cap. So what you have is all of a sudden owners are going, well, if they have to go get debt, I just lost huge amounts of money that could be paid to me. So what we do is say, all right, if you finance this at 4%, I can pay you a 7 cap. If you do like a middle ground, I can pay you an 8 cap. But if I have to go out and finance this on my own, I have to pay a 9 cap. So meaning that when I say cap rate, let's just think about it this way. If I have to finance this with a bank, I've got to put all this money down. I have this huge interest rate. In order to make these deals work or even cash flow, I can pay you $1 million. Now, if you will carry part of it, make the down payment that I don't have to put in, I can lower some of the expenses of payment. We'll do a middle ground thing. I'll pay you $1,250,000. But if you will finance it, take that risk, and I only have to put this much down, I'm not going to be a guarantor on the asset, and that interest rate's going to be so low, I'll pay you $1,400,000. Why? Because now I can. The deal at those levels, cash flows the same. The only difference is, seller, what do you want to take? So first of all, they can usually get more money. Now, even at that, it's still less than we were paying 3 years ago, right? But they can usually get more money than they could if you finance. Also, they don't have to pay taxes. And today, a lot of them are looking at, what do I do with the money? Like, what am I even going to do? I need cash flow. I don't know what to do with the money. So then you're financing and you're giving them monthly payments. They're actually getting cash flow. And they don't have to deal with the asset at all, yet they're still making money.
Such an amazing deal.
And lots of times that money they're making is almost the equivalent of what they were making anyways.
Dude. That's what I've always been boggled by, where I'm like, you could exit the business and literally be making the same amount. That's where I probably didn't do a good job explaining it, but on that one that was seller finance we looked at the beginning, where it's like, there was a ton of value add, it was low occupancy, all those things. I'm like, dude, just like going in and be able to buy the asset, improve the value, the owner's literally getting paid just as much or more than they were previous, and they've exited. Like, it's an amazing setup for them.
It's amazing. Sure. And when they look at it too, you guys got to realize, okay, when you're buying that and you turn it around, that means that equity is improved. You put more value in it, cash flows more. What now happens is you can finance or refinance, get the seller out, take out more money, whatever you want, on your terms, right? You're not going to be like, well, I have to do this now and interest rates are at this level, so it won't work, all that, right? You have more power and control than you would if you were with a bank and had strict terms and all of that. Now, the one thing that I need to say that is a precaution though, and I've said this, I'll always say this, do not guarantee seller finance deals. So don't personally guarantee, ever, ever, ever. And we had a deal and we were talking with these guys and they were like, hey, we want you to personally guarantee. And I was like, I'm not going to do that. And they go, well, hold on. Do you think that risk is more, a bank is more important, that they should get it and we shouldn't? And I go, well, no, hold on. I'll make you a deal. I will guarantee privately that loan that you have against me, as long as then you guarantee me all the government protections that come with a bank, meaning that you can't just do a civil lawsuit. You can't just get the money. You have to go through all the processes, approvals, foreclosures, you have written notices. Banks are very much regulated and they just can't take your assets. They just can't do this. When you are not using a bank, you guys, that individual does not fall under those regulations. So they can do things civilly, meaning I can just sue you and say, I want my money back, right? And we know that people are sue happy. And then they can say, not only do I want this, or I think something's going wrong, or I don't feel safe, I want your other assets as well. You do not have government protections. That is the big thing that I tell everybody. Don't put yourself in that position. Do not personally guarantee when a seller is being the lender. Why? Because you do not have the protections that you would if you had a bank. And you can tell them that. And if they want to do it, then you say, you're going to have to sign all these documents and everything else, and I'm going to have all these protections, on and on and on and on and on, which of course nobody wants to do, and they're not going to do. That's the one thing with seller financing I just want to put out there.
Good point.
And there's lots of ways you can structure it, but lots of good things, but just do it right? Now, once again, too, when we did seller financing, a lot of you go, well, that's complicated because now I need to figure out how to do it. We had no idea how to do seller financing. I technically don't know how to do it today. I don't know how to make the documents or anything else. Just like when getting investors. We say, hey, seller, I'm going to make this really easy for you guys, because everybody goes, well, how do I even talk about interest rate, everything else? I go, don't. We would talk to the seller and we would say, hey, well, okay, if you were to sell, what do you need to make a month? And I'm like, well, I'd like to make $5,000 a month off this if I could. All we did is went back and looked at the numbers and said, okay, we can pay X amount this, and that works in our numbers. And then the attorney just drafts up the documents according to it. They get what they want. And if it works for us, we get what we want. Okay. The attorney does all that other stuff. We just come together. If they say, well, I want this, this, and this, I want a huge interest rate and huge money down, everything else. And you go, well, that doesn't work. So no, right? This is what works for the deal at the price you want it. That's it. Just figure out some numbers. Attorneys, they make up the documents. You tell the attorneys what you want, and they make up the documents. You don't have to be a financial expert. You don't have to understand financing. You're not a bank. You don't need to do that. It's a private document. You and the seller figure out the agreement. Then you work with an attorney to build that agreement out so it'll work. And he'll do those things. He'll show you where the red flags are, what you need to cover, all that kind of stuff. You would tell him, this is what we want and what we don't want, what we're trying to achieve here. Okay. And that's how you go about it. That's the same thing you would do if you were working with the bank. Meaning if I go to a bank, banks are going to say, one bank may say, all right, you have a 7% interest rate on a loan that is locked in for 3 years. Another one may say, I'll give you an 8% interest rate, but you only have to put 20% down, but it's going to be locked in for 10 years. So one, I have to put 35% down. It's only 3 years and it's a 7% interest rate. There's pros and cons to that. It's a lower interest rate, right? I may have to put less down, or I have to put more down. The other one, it's locked in longer, but it's a much higher interest rate. Meaning, guys, all you're doing is plugging in the numbers that the bank gave you and looking if the net income, that's it.
Yeah. Is it work or not?
Is it work or not? That's all it is. And that's what you would do with the seller finance deal. What am I paying you for what period of time? Mm-hmm. And then what are the risks? Does that work or does it not?
I'm so glad you touched on that, because I think a lot of people get hung up on that, where they're used to working through the bank, whether you're purchasing a house or you're getting a loan, whatever. Right. You're like,
here's what you get.
Well, yeah, how do I do it? Because they just give me paperwork and this and that. Like, where do I get it? So I'm glad you touched on that. And another thing that I think is just amazing about seller finance is especially when you're just starting out, you're not negotiating with the bank most likely. Whereas when you're dealing directly with the seller, you can have those discussions and negotiate terms, right? Yeah. Which is just another thing that I think is super, super important and really helpful for people when they're first starting out. Because you can say, give them the options, like you said. Well, we can give you this price at this interest rate, or this price at that interest rate for this term. Like, you can actually have the discussion as opposed to just being handed the term sheet and it's like, yeah, you can sign it or not.
Yeah, exactly. It's a great way to do it. I don't want you to be overwhelmed by it, and that's what I'm saying. Two, even realizing, even like Connor was saying, they can you can just do the numbers and work through it. When we were doing our first seller finance deals, we didn't even know what a cap rate was. We didn't even judge value by that. So these people that are doing seller finance deals that you guys are seeing, right? They didn't either. One was a chef. This is not. They don't know anything about that, right?
That's awesome.
So of course they learned all this stuff, and we help them out through our programs, everything else. But that's stuff you just learn, right?
Yeah.
Now, I think before we end here, we got to talk about the other piece. We've talked about the debt. We talked about case studies. The other piece, though, is that equity piece, meaning that amount you put down. So how much do you put down on that property? We've seen through some of these case studies, we had 10%, other people put 25% down. We put on most our deals 35% down, but that's because we're doing bigger deals. And they're using, a lot of these are doing seller finance or small business loans. So they're much more flexible. When I'm buying a much larger asset, things like that, we're going through traditional means of financing. But however much you're putting down doesn't mean that either you have to do it alone, right? Most of all these people went and got partners. And by partners, I mean investors. So I know one of them got one single investor that wrote the check and came in. And other ones used them and their family and friends. Then I know other ones that go out to more people. But that's what they're doing. They're pitching in their money, a little bit of their money, or if they don't have any, none of their money, and they're using the investors' money to come together to put down that down payment. So on this deal, you have, $350,000 deal. You put 10% down, he needs $35,000, right? And on and on and on. That's how it works. That is normal. That is 99% of all deals done. Every deal that we do has investors. If it didn't, we couldn't be doing deals because real estate is a capital necessity business. So don't think, everyone going into it, well, I don't have the money, I can't do it. I don't know one person that has the money to do what they're doing. Yeah. That's not how it works. You have to use banks and you have to use investors, right? So no matter how you structure it, that's common, normal thing to do. Get investors to put it down. If you have the money, that's amazing. If you have the $35,000, you can do that, put it down, great. Now, what happens is you'll build it up, you'll get more cash flow, you may refinance, then you want to buy more. And eventually you're going to say, great, now I want to buy 2, 3 more, I need more money. Or you may have $250,000, you're like, I can buy 2 small storage facilities, and you want to go do that. That's fine. The great thing about this, everyone, is there isn't a set way to do it. So no matter what your circumstances are, is kind of irrelevant. You just need to work your circumstances within it. None of these people had experience. You need to learn, and then you need to figure out what tools you need and what resources to do the thing.
Mm-hmm. That's such a great point, man, because I remember way back in the day when I started just, reading the books and just starting to learn about whether it was real estate or business acquisition. That was one of the biggest questions in my head was how are the deals structured? Like, what's the standard, quote unquote,
Yeah.
And to your point, there's not just one way to do any of it. So don't get hung up on that. Literally anything is possible. You could literally go to a seller, and they could do 100% seller finance with 0% down for a million years. Anything goes.
All these deals are different, and every deal that we do different. Why? Because the seller and the buyer have to structure a deal to get it done. So it's not like it's houses, right? This isn't like, all right, well, this house is selling for this price at the market. Everybody buys this quality, this many bedroom, everything at the market. That's what it goes for. That's what it pays for. Everybody knows. That's not how this works, right? I haven't seen a deal that sold at market price or above, I think, in 3 years. I don't think I've seen one, right? So it's a negotiation you're trying to work through. We look at deals and we say, how much will this make? And then how can we buy it to make whatever return we want to make? That's it. That's all we do. We literally have our formula. We have our golden ratio that we look for on as far as returns that we need to meet. Every deal that we do is different. That's something that's normal and expected. So you say, I want to know what makes a good deal, and then I need to learn how to structure those deals, right? And that's why we're here. When we talk about things like seller financing, banks that you should use, right? Where these people found their deals, how much the deals are in comparison, everything else. We're talking about all those things. Learning how to structure a deal, regardless of your situation. And that's also why just because a deal wasn't a deal for one person doesn't mean it's not for another. Mm-hmm. This is the greatest thing ever about this game, because it's not like you either are in or out. No, not how it works. You don't either have it or you don't. No, not at all. And when you're dealing with assets, everybody, that are below, $2 million, well, then it's really open.
Wild West.
Wild West, and you have lots of opportunities because there's not all this capital that is just saying, no, we'll all compete, everything else. Yeah. Sellers are willing to do things. You can find investors that want to put money because you're talking about, I need 35,000 or maybe 200,000. Friends and family, they put their money together and you can go buy one. This now gives you experience. This gives you ability to generate returns and build a resume. And this creates wealth for you, right? So using other people's money or saving up and doing it by yourself, whatever, it's okay. You can do all those things. Remember, everyone gets caught up in, I think, the dangers that they see. You don't do those things. Like, people are like, don't you worry about if you structured this wrong or did that? I'm like, no, because I have people that actually know what they're doing. Mm-hmm. The attorneys, we figure it out. They help me. I don't expect myself to know, and I don't try to know. I know the basic rules, right? I know the difference if I'm sending out emails or I'm trying to raise capital, everything, to make sure I'm doing it right, of course, right? But I only know that because that's what the attorneys told me.
Right.
That's it.
And you're not going to eliminate 100% of the risk ever.
Ever. No, that'll never happen.
No.
And I think that a lot of people don't realize the opportunity that's there right now. I really do believe that. And the reason is the pessimistic view of the market, where interest rates are, that actually makes people go away that's when all the opportunity is here. What we're showing you, these stories of these people that are in our group, everything else, this is just a small sample of everybody that's doing and going on. We did not see this. In 2020, 2019, 2021, it was not like this. It was very, very different. There was not opportunities, good deals like this. People weren't going out and getting seller financing, all this stuff. That wasn't happening. Mm-hmm. Today, it's happening all the time.
Oh, and it's happening more and more. I mean, we were just talking to our head of acquisitions the other day. I mean, we're shooting LOIs out like crazy, getting responses, getting PSAs signed. I mean, I have not seen deal flow like this for years, man. It's amazing.
It is amazing. And I want everybody to remember, you're not doing it on your own. You have resources. We try to give out as much free things as we can. The YouTube video, you go buy the book. We put it literally at the price that Amazon makes us do in order to pay Amazon. That's it. That's the price of it. I don't make anything off it, right? So you go buy the book, you go to the YouTube, you listen to this podcast. Those are all but free. You got to pay to get the book to Amazon, not to me. But all of that, guys, that's essentially, we're just giving out free. Mm-hmm. If in more than that, you say, no, we want to know more, we want to hand holdings, everything, then we have groups and communities that you can join. Mm-hmm. And those communities, we're doing things. We even send deals to our community. Our community is buying deals that we bring to them even. So there's so many resources that you're not doing it on your own. There's attorneys that specialize in things like securities. There's attorneys that specialize in real estate and land deals. You're not alone. And right now, there's a lot of people that aren't doing deals. They don't have opportunities. So the demand for you to put together a deal, to go out and find a deal, to buy a storage facility is really, really high. And so get out there and get it done.
Yep. Now's the time, guys. Thanks so much for listening. Catch you next time.
Thanks, everybody.